Why isn't there a clear and straightforward answer to this question? How much income will my pension fund provide me with? Well, today we're going to look at exactly how much you might receive from your pension fund based on three fund values of 100,000, 300,000 and 500,000. Hi, my name's Andrew. I am a chartered financial planner based in the UK, and I help people make decisions around their retirement and their finances generally as part of my day job. I started this YouTube channel to bring my insights to a wider audience, so if you're new to the channel, tap that subscribe button for plenty more to come in future. When it comes to taking money from your pension, you'll have two main options. The first of those is a guaranteed income for life in the form of an annuity. Now you can compare across insurers that provide annuities. They will offer you a guaranteed and specific amount of income for the rest of your days. And once you've accepted that, it's pretty much set and forget. There's no going back on it, but it is guaranteed for your life. The insurer hopes you'll get run over by a bus tomorrow, and you hope you'll live a long, happy life and get plenty of income from that annuity. An annuity could be a very viable and sensible option for many people. It takes away some of the hassle and maintenance that you would have to deal with in the alternative of drawdown, which I'll come to in a moment. Annuities offer more certainty and security, allowing you to budget and manage your finances without worrying so much about whether you'll exhaust your pension pot due to investment returns or withdrawals. Annuities fell quite heavily out of fashion, largely due to low interest rates, and in 2015 pension freedoms made drawdown all that more appealing. But if you are looking for a guaranteed income, and with interest rates being a little bit higher than they have been over previous years, I thought it'd be interesting to have a look at these figures, see what annuity rates are typically offering today, and I've looked at retirement ages or annuity purchase ages of 55, 60 and 65. Now I've made some assumptions about the annuity that will be purchased, but the key options that I've shown here to give some scope of what different levels of income would be available from annuities are zero death benefits or including a 50% spouse's pension. So on death, half of the income continues to your partner. And the other key option I've shown is a higher starting income, but one that does not increase, often referred to as a level annuity, or an income that starts lower but increases in payment each year in line with inflation, linked to RPI in this case. Keep in mind that annuity income is subject to income tax at the rates that it falls into the bands, so if you're a basic rate taxpayer, you'll have 20% income tax coming off these figures. And it is important to note that there are tons of variables, things like where you live, your health, your lifestyle, and the options that you include with an annuity, particularly death benefits and whether you include inflationary increases or not. It does have a major impact on the level of income that you get, but at a high level from these figures, we can probably say that a flat income, a level annuity, will provide around 6 to 7% as an income rate from your fund value, and that an inflation-linked one will be more in that 3 to 4% range, perhaps towards even 5%, depending on when you retire and what you include within that annuity. Now, it might be more tempting to go with the level income and take 6-7%, but do keep in mind that the risk of inflation is huge. You might live for decades after taking this annuity, and for example, I had a quick look at the Bank of England inflation calculator to show that an income of £20,000 20 years ago would now need to be about £35,000 just to buy the same level of goods and services. What I would say on annuities from a planning perspective is that if this income is for leisure, for lifestyle, holidays, discretionary spending, then yeah, taking the level option is probably more attractive because you'll do more in your earlier years and you can afford to accept some inflation risk. But if you're going to use this annuity income to pay the bills, then having the inflation-linked option would give much more security for you in the long run. One of the key issues with annuities for those retiring before state pension age is that the level of income that they would be offered as an annuity might not be sufficient to allow them to retire, or at least fully retire, and that's why very often drawdown with its flexibility becomes more appealing. Which brings us nicely on to this alternative option of drawdown, where you retain your pension fund and gradually draw down from it what's needed. The rules now allow you to take what you want when you want. And people like drawdown because you've got that ownership of the fund, there's the flexibility of income, as mentioned, and on death, it can be passed on in full to your nominated beneficiaries. The flip side to drawdown is that it brings in a lot more risk and responsibility. It needs you to make a decision about when you take money, how much you take, and whether you invest and how you invest. So you can start to see that the level of income that you might get from drawdown can't be certain. It's not guaranteed like it is with the annuity option. And the question really becomes, well, how much can I draw without running out of money? What's a sustainable level of income to be taken from a drawdown fund? To help give you an indication of what you might be able to draw from a drawdown plan, I'm going to take the 3 fund values that we're using here and then work with the financial planning software that I use to plan with clients in my day job. And we're going to look at the probability of you not running out of money. And you'll start to see that it is probability that is key here. To be able to analyse this, I'm going to need to make some assumptions. So we'll work to starting ages of 55, 60 and 65. We'll assume that you live until age 95. There's about a 20-25% chance of this based on national statistics. We'll use a 3% annual inflation assumption, and we'll work to the basis that you invest in a fund that has about 60% owning companies, a basket of shares, and the other 40% in the more defensive end of fixed interest. You might say a typical kind of middle of the road fund. And the crucial bit for this is that we'll need to assume a success rate. So we're going to work to a 90% success rate in this case, which is pretty key. Realistically, I'm saying I want to see a 10% chance or less that I will run out of money. Now, baking in all of those assumptions and using Voyant Monte Carlo analysis to probability test our scenarios here and look for that 90% chance, what we can say, based on the figures as I presented here, is that roughly a withdrawal rate somewhere in the region of about 2.7% to about 3.4% a year should be sustainable as a starting point if you would then increase that with inflation all the way up until you reach age 95. Let's take a step back a second. If we're assuming that we're going to invest in a fund that has about 60% in equities, a basket of owning companies, typically over the long-term average, that should be about 6 to 8% annual return. If we use the Vanguard Life Strategy, 60% equity version of that fund, and look at it from launch in 2011 through to where we are today, it's averaged about 7% as an annual growth rate. So why would it be that we can't just take, say, 6-7% a year and never run out of money? The answer, of course, lies in the 2 key variables that we can't know in advance as we use a drawdown plan throughout retirement, those being inflation and investment returns. They don't come in a nice straight line, although we've talked about averages here. They are variable, and particularly with investment returns, you can have significant ups and downs throughout the years. And as soon as you start withdrawing money from your investment, if the investments have fallen significantly and you take money out of that, there will be less in the fund to recover when markets inevitably go back up. And this sequence of return risk presents a real threat to your drawdown plan during retirement. But you might say, come on Andrew, surely you're being overly pessimistic, overly cautious here. 2.7, 3.4% withdrawal rates, surely I could be taking more than that. Well, yeah, I probably am in this scenario. I mean, if we look at the projections from assets over time, looking at multiple scenarios, all of those hundreds of outcomes that you might have got, it's probably more likely that you die with hundreds of thousands still left in your pension than you would do running out of money. By looking for this 90% success rate out to age 95, I'm just effectively protecting you from the most pessimistic, that worst 10% of scenarios out at that age. And you might feel far more comfortable accepting a lower success rate, 80% success rate. You might take a very different view about your longevity and how long you'll live. So there is no right answer here. There's no specific, you can take this amount. But I would look at some of these variables around longevity. I would think about how I'm going to invest, because if you're willing to take more equity risk, again, we could nudge up those withdrawal rates. But look at those variables, and the point with drawdown is that you make a plan that you are comfortable with. And then next year, when the world hits you with the unexpected, you stand back, you reflect, you adjust, and you go forward from there. Yes, I might be being cautious on those withdrawal rates that I've shown here, but I do think it gives a starting point, an indication of what's possible over that time frame. What I thought was most interesting from exploring these figures was that my arguably safe withdrawal rates from drawdown were actually slightly lower than the guaranteed option of an inflation-linked income, an annuity for life. I'll often hear that annuities aren't great value, but given where interest rates are today, and I know that that's a variable, annuity rates could certainly change in future, but as things stand today, it certainly presents a compelling option to at least consider if you're thinking about taking an income from your pension. The upsides, the advantages to drawdown are obvious, and I think ownership of the fund and keeping it in the family on death are 2 points that will keep drawdown a popular option for many years to come. But it is certainly worth weighing up the two routes and thinking about what might suit you better for your circumstances. While ever you have a drawdown fund, it does keep the option of an annuity purchase open for the future. Whereas with the annuity route, I suppose one of the big trade-offs is that there's no route back out of the annuity product once secured. But what's your take on it? What's your thoughts having looked at some of the figures? Are you planning to do drawdown with a specific withdrawal rate? Do you think I'm being overly cautious here? Are you using a higher withdrawal rate and feeling pretty comfortable? What's your take on longevity and some of the factors that play into that? Let me know in the comments. I'd love to hear about it. And I look forward to seeing you for the next video.